So we discussed about the flow concept yesterday, and today we'll just take it forward from there. So flow basically means inflow and outflow, inflow of cash or funds, or outflow of cash and funds. Right? These are the two things that can happen. So when this happens, there will be changes in financial position of the company. When there will be an inflow, there will be a change, and similarly, outflow also result in change in the financial positions. So as we discussed yesterday, balance sheet was just a snapshot. It won't tell you the changes that are happening in the background. So we have to compare two balance sheet dates to know what is happening. Similarly for P&L, if you compare two P&Ls of different years, you can see the changes. So this changes is more reflected or captured in two statements called as cash flow statement and fund flow statement. So these are known as the statement of changes in financial position, cash flow statement and fund flow statement. Now, to prepare these statements, to prepare cash flow statement and fund flow statement, we are basically going to use balance sheet information and P&L statement information. So we are going to look at, compare balance sheets of two dates and similarly P&L of 2 years and use that information to prepare cash flow and fund flow statement. Now, before we proceed to do those statements, learn about the statements, I just want to brush up your basics once again because you have to be very clear about the components of balance sheet and P&L before you go to the cash flow statement and fund flow statement. So let's just revise the balance sheet components. These are current liabilities. You will have trade creditors, those who are your suppliers. Then you will have bank OD, bills payable, your provisions, and other short-term liabilities. These are to be repaid in 1 year, repaid in short term within 1 year. And then you have current assets, which will include cash, bank balance, inventories, trade debtors, people who have taken your goods but not given money yet. Then bills receivables, your short-term loans which you have given, not the ones you have availed, but the loans which company has given to others, and your temporary investments. These are to be converted into cash within 1 year. Converted into cash within 1 year. We told, we discussed last time that this was basically a heart of the company. You have to keep this pumping and convert it into cash to run the company. And then you have non-current liabilities, which are long-term sources of funds. So it will be equity shares, reserve and surplus, preference shares. So these are basically, forms part of the owner's equity or capital shareholder funds. And these are loans, long-term loans. So these to be repaid in the long term. You will have more than 1 year to repay them, repaid in long term. Then you have non-current assets, again, which are also assets which will yield benefit in the long term: land building, plant machinery, furniture and fittings, vehicles, patents, trademarks, and goodwill. So these are the components in balance sheet. Now just do an exercise to quickly, revise what we learned. How are you going to classify this? First, let's look at trade creditors. Trade creditors are, suppliers of raw materials. You can imagine them as suppliers of raw materials, who have supplied you raw materials, but you have not given them money in return. So it's basically getting raw materials or inventory on credit. You are yet to pay them. It becomes a liability, but you have to pay them once you sell your goods. Once you sell your goods and get money from that, so you will have some waiting period before you can give them the money. So trade creditors is a liability, but it is a current liability. Similarly, trade debtors is the opposite of that. You have sold them goods, but they have not given you money, returned, paid you for your goods. But they have asked for you for some time, so they'll become your debtors. But they are going to pay you in short term. You will get cash from them, so they become your assets. They are current assets. Then reserves and surplus. Again, these are liabilities. The profit is added to reserves and surplus. Then it becomes a liability to the company, to the owner, and this is a non-current liability. And then other assets will be, which are not current assets, it will be non-current assets. So this is a quick classification. Now just to test your understanding, which of the following is least likely to be an advantage of statement of changes in financial position? So we discussed about financial position changes through cash flow and fund flow. And let's look at the options. It explains the changes that happened in investment in assets. Yes, it will help to tell that how the investment assets changed. It shows net profit for loss or given for a given period of time. It describes changes. Yes, again describes changes that have been made in collecting fund or investing in business. Factors that have been responsible for difference in equity assets and liability. So all these changes are reflected. But the question is, what is the least likely outcome from this financial position changes statement? So net profit or loss is not what you get in this. You already get this in P&L statement. Our statement of changes in financial position are basically cash flow statement and fund flow statement. So these statements basically tell you all other things like changes in investment, changes in investing, difference in equity, asset, and liability. So B is your answer. The question asks about least likely outcome. Which of the following represents statement of changes in financial position based on working capital? So working capital is means your current asset and current liabilities. The difference will be the net working capital. So this will be reflected. It will not be reflected in P&L account. So those changes, change again. It's a statement of change they are talking about. So this will be reflected in your fund flow and cash flow. The answer will be both 2 and 3. Now let's talk about funds. And in funds we'll have inflow and outflow. So inflow means source of funds. Funds would come in from sources and then it would be used for certain activities of the business. So application and use of funds will be the outflow. Now how to identify this using balance sheet items? So between two balance sheet dates, if the liability is increased, then it will be called a source of funds. That means suppose your liability was 100 in 2023 and in 2024 March it is 200. So liabilities have increased. That means you have taken more loans. So more loans will bring in more funds. Okay, so it's an inflow of funds and it is a source of funds. So liability increase will be a source of fund. And if assets decrease, so you can sell your assets and generate income from that. So that will also be a source of fund. Now, between two balance sheet dates, if liabilities decrease, so your liability was 200 and now after 1 year, if it's 100, clearly you have paid money and reduced your loan amount. So when you're doing that, actually you are using funds. There is outflow of funds from funds or cash from the company's assets and it will go to closing the loan amount or reducing the loan amount. So it's a use of funds. And similarly, if assets increase, then what happens? It shows that you have purchased new assets. For purchasing assets, again, you need funds, you will use funds, so it will be again an outflow. Now we'll understand this concept. It's a very basic concept. You need to get it, really understand it well to further study about cash flow and fund flow. Let's look at this balance sheet. ABC Traders. Look at the balance sheet. This is as on March 31st, 2024, and then you have the same balance sheet of the company on March 31st, 2025 after 1 year. So let's see what all changes are happening. First, you see what happened to the equity capital. It was 50, now it has gone up to 60. So that means owner has invested 10 lakh rupees, the capital has gone up. So equity is a liability. Liability in the form of equity has increased. Whenever liabilities increase, it is a source of fund. It is where money comes from. Look at long-term loans. Long-term loan is 30. Now it's gone up again to 40. So they have borrowed another 10 lakh as long-term loan. This is also a source of fund. Look at short-term loans. Again, it has gone up. So it has taken more 5 lakh more loans in short term. So again, it is a source of fund. And what happens to account payable? Account payable is same as almost trade creditors. That means you had to pay someone money that was 20 last year. Now this year, this has increased to 25. That means, the supplier is giving you more money, more credit. So you are again saving money. So it is an increase in your source of fund. So again, the delayed payment means the cash will be left with you. You don't have to spend it. So delayed payments always means account payables increase means it is also a source of fund. Now let's look at the uses of funds. So use of funds is basically either you repay loans or you increase your assets. That's what we learned, right? So let's see this table. Cash was 20, now it's gone down to 50. So cash has decreased by 5 lakh. That means you have spent your money. Money was spent and it is a use of fund. Account receivables has gone up from 15 to 25. Now again your cash has increased. So sorry, not cash, your account receivables has increased. So what's happening with account receivables? Your credit sales are increasing. Okay, that means your funds are kind of stuck. What is account receivable or credit sales? That the customer has taken your goods, you have sold goods, but you have not got your sale money. So that money is stuck. So again, that money which is stuck has gone up from, it was 15, suppose let's say it's 15 crore or lakhs, 15 lakhs was pending from the customer. Now this year the customer has to give you 25 lakhs. So that thing has gone up, the credit sales has gone up. So again, it is not bringing you money. Your money is stuck. It is again a use of fund. Then inventory has gone from 30 to 35. Again, you have spent your money. So spend means it's again a use of fund. And fixed assets, it was 45, now it's gone up to 65. Again, you have purchased additional 20 20 lakhs worth of fixed assets. So that is also showing a use of fund. Now, to show this in a real world perspective, how it happens in a real company, we will use the example of Tesla. This is Tesla's one of the factories of Tesla where they make those trucks. Now let's look at the balance sheet of Tesla to understand this concept further. So this is the asset part, this is the liability and equity part. So you have got two dates here. This is one balance sheet on December 31st, 2023, and then in the next quarter, March 31st, 2024. Let's see what happened between these two dates, and we will see how source of funds and use of funds, basically cash inflow, and outflow. This we will study using Tesla's balance sheet on 2 days. So let's start with inventory. What's happening with inventory? Inventory was on December 2023, it was 13,626 million, and then it has gone to 60,033 million in March 2024. So clearly, there has been an increase, roughly 2,500 million. So increase in inventory, more inventory has been purchased. So asset inventory is an asset, so it has been purchased. So that means it is an outflow of funds. Outflow of funds. This is use of funds. What's happening with property, plant, and equipment? They had property, plant, and equipment worth $29 million in December 2023. Again, it has gone to $31,436 million. Again, roughly $2,000 million of assets, long-term assets like property, plant, and equipment has been purchased. So when $2,000 million worth assets are purchased, what again happens? You have to spend money to get those assets. So it's an outflow. It's a use of fund. Now let's look at liabilities. Accounts payable. Accounts payable are like credits. Credits you get from your supplier. So the account payable was 14,431 in December 23. It has slightly increased to 14,725. Roughly, you can say by $300 million. So accounts payable has increased. That means you are getting more credit supply. Your liability has increased. Your credit supply has increased. Now the creditor is giving you higher amount, and so this is an increase in liability. Increase in liability is always an inflow of money. You can just imagine it as getting more loan, higher loan. So it is an inflow, and this will be again source of funds. Inflow will be a source of fund. Let's look at another term, other long-term liabilities. Long-term loans, it was 8,150. Now it's gone to 8,480. So roughly an increase of $300 million. Again, increase means inflow, increase in long-term loans, inflow, and this is a source of fund. So I hope you have understood how changes in balance sheet will result in inflow of funds and outflow of funds. So these are some of the different items where you have sources and users. Net profit, if it increases, it will be a source of fund. So depreciation is also a source of fund because it is just an accounting term. In reality, there is no spending. So if you add back depreciation, it will bring more money. So it's a source. Increase in capital is a liability. So it is also a source of fund. Increase in long-term liability is also a source. Then decrease in fixed assets. If you sell some of your fixed assets, it will bring in money. This is also inflow. Inflow means source. Again, decrease in other non-current assets will also bring in money. So that is also a source. So you can see this is, we'll add all the totals here. So here it is listing out different sources, basically inflow of funds, how you can get or bring in more money. This is inflow, and you will sum all these inflows. Now let's look at the users. Users are basically outflow, where money will go, where you will spend. So if there is a net loss, so the losses are increasing means again your money is wiped out. It is use of fund and outflow of fund. Decrease in term liabilities. Your liabilities, you are paying off your loans. Then only it will decrease. When the decrease happens, there will be an outflow of fund, and it is a use of fund. Similarly, as we discussed in Tesla, their fixed assets was increasing, so that will be a use of fund. Similarly, if they pay dividend payments, if dividend payment is made, again you have using the money, so it is an outflow. It is a use of fund. Similarly, we'll sum up the all these uses. So then we will net them out. We will see whether it is a surplus or deficit. So we'll compare the balance sheet and find out balance sheet and P&L, and we'll find out whether there is a fund surplus or fund deficit. So you make a table like this, and finally decide whether there is an increase or decrease in fund. So I hope you have got the basics of this fund flow statement. We will discuss the remaining topics in next lecture.